Okay, so we are a go now. A very good afternoon, ladies and gentlemen, and a very warm welcome to all of you to the FTI ELP webinar, which is aptly titled to my mind, which is Navigating the Global 360-Degree Impact of COVID-19. And a very warm welcome to all the panelists who have joined us here. As Chef would actually say, that we have a delectable, a choice of panelists with us today. And I'm sure, all of us are going to enjoy hearing each one of them give their views on the topic that we've chosen. Now, the question on everyone's mind surely would be, why this topic and what are we going to deal with today? So let me try and summarize the proceedings for today without disclosing, obviously, as what Mr. Nahta would actually, all the time be very cagey about. Never disclose the suspense. Go watch the movie and then you would know the suspense. So let me try and summarize, today's proceedings for you. So despite a growing clamor amongst nations to close borders, what is nature today teaching us? It is teaching us a very important lesson, that it does not recognize nor acknowledge any such man-made impediments. It took the political class across continents half a decade to close these artificially created boundaries. And on the other hand, nature just needed one small, seemingly inconsequential strain of submicroscopic infectious agent that we know as a virus. And if you're wondering where I got this from, I actually Googled it just before the start of the webinar, and that's how I know that a virus is known as a submicroscopic infectious agent. But that is what it took for something which is invisible to human eye to make us realize that now, more than ever, we humans need to collaborate to ensure, more than anything, survival possibly of our kind. Now that I have maybe dramatized this as much as I can, let me try and bring the focus back on why we organize this webinar today. We live in times when the world is routinely impacted, and we see this on a daily basis, that we are routinely impacted with events that are unusual, be it the pandemic, which, if I may say so, is the flavor of the season, or any other socio-economic, political trigger. In the 1990s, and we all are very familiar with this, that in the 90s, India opened its economy to the world. We got rid of what was known as the license Raj and the Babudam. But these are accolades of the past. Since then, while we have made steady progress, but largely we have relied upon that one single event to define us, which made us a part of the global village. It is about time that we realize that the world has moved far beyond the 1990s. And if we need to thrive and not just survive in this changed world, India needs to be far more proactive in its approach. Globalization is seen and felt in everything that we do and experience, be it health, be it economic growth, talk about environmental concerns, infrastructure development, or even media content. Today, we watch shows produced by foreign filmmakers. So let's talk about Money Heist and Dark, and I'm sure a lot of you who are hearing me will immediately find a connect. Now, these were hitherto inaccessible. We share and obtain technology in the pharma sector from global partners. We routinely cross borders through groups such as Shapurji Palanji and acquire and build assets in different jurisdictions. We study the impact of economic crisis in other nations and think of measures to alleviate it, as they are a part of the global appendage. And if we are forgetting all of this, the pandemic is a sharp reminder that man-made borders are inconsequential. The webinar is not simply about India, although it is India focused. We have for you, like I said, a delectable assortment of speakers who in some capacity or the other have experienced many course-changing events in their career, which have had global impact. So do be with us for the next hour and a half as our panelists traverse and analyze through several lenses the impact of COVID-19, the path forward, and the revival and resurgence that we all desire. Our panelists today will analyze and present their views on the impact of the pandemic through three-fold lenses: economic, legal, and never the last and never the least, the industry user. They will present to you their views on what we are enduring, how best we can survive this time, how to revive, and last but never the least, how to thrive in this environment. Will all of this need a shift in social norms and attitude, a transformation in business relationships, a change in policy, a revisit of the law, or a rehaul of the bureaucracy? I shall let our esteemed guest for today help you look past the so-called new normal, because it is no longer new, and certainly it is no longer the normal. Ladies and gentlemen, therefore, without much ado, let me hand you over to the first moderator for the afternoon, Namrata Shah, to introduce the panel and to take the first session forward. Thank you.
Thank you, Naresh. And firstly, congratulations to you and everyone at ELP on your listing in the Global Arbitration Review with 100 other firms from across the world.
Thank you so much, Namrata. Thank you.
We're especially grateful to ELP and to FTI Consulting for organizing this event today. And we're also grateful to our supporting partners, the Hong Kong International Arbitration Center, the Mumbai Center for International Arbitration, Film Information Magazine, the Bombay Chamber of Commerce and Industry, Norton Rose Fulbright, Bar and Bench, and the Center for Arbitration and Research at MNLU Mumbai. Good afternoon, everyone who's joined us today. I am Namrata Shah. I'm a Principal Associate at Rashmikant and Partners. And I'm going to be moderating today's session along with Alok Jain, who's an associate partner at ELP and is extremely experienced in their domestic and international arbitration practice and in dispute resolution across India as well. I'm very honored to introduce our panelists today. So first we have Saugata Bhattacharyam, who is the Executive Vice President and Chief Economist at Axis Bank. He's a very well-known authority on monetary policy and finance and has served as an advisor on working groups for the Finance Ministry and the RBI. And in conversation with him today, we have Mrinal Jain, Managing Director at FTI Consulting. Mrinal, firstly, thank you for bringing us all together today. And Mrinal is well recognized as a leading expert witness in international arbitrations on quantification of damages and claims. He also serves on the advisory board for the Center for Arbitration and Research at MNLU and is on the board of the Society for Construction Law. For our second session, we have two arbitration practitioners, Sherina Petit, who heads the international arbitration practice at Norton Rose Fulbright across Asia, Europe, and the Middle East, and also heads the firm's India practice. Sherina is also on the board of the LCIA, the ICC Indian Arbitration Group, and the SIAC Users Council. Sherina will be joined in discussion with Abhileen Chaturvedi, who is an associate partner in the arbitration and dispute resolution practice at ELP. Abhileen has expertise in both domestic and cross-border disputes across a range of sectors, including banking, construction, technology, and telecom. And then for our final session, Alok will be discussing the impact of COVID with two industry experts, Komal Nahta and Zarina Pundole. Komal Nahta is a celebrity who is a veteran in the Bollywood industry. And in addition to being a Bollywood trade analyst and film critic, he's also the publisher of Film Information, the leading film trade magazine, and is also the anchor of the trade show ETC Bollywood Business. Mr. Nahta was also the Bollywood representative of BBC for almost 10 years. And along with him, we have Zarina Pundole, who is the general counsel and legal head of Shapoorji Pallonji's EPC division. In addition to being a solicitor as well, Zarina is also qualified to practice in New York and in Texas, where she practiced for 10 years in a variety of areas of law. Thank you all for being here and for taking the time out to have this discussion with us. While the pandemic has caused unimaginable havoc, I am also hopeful that some positive changes will come from this. And so let's start with our first session with Saugata Bhattacharyam and Mrinal Jain.
Thank you, Namrata, for the kind introduction. And first of all, heartiest congratulations to Naresh, Alok, Abhileen, and the entire team of ELP for the GAR listing. That's commendable, Naresh. I'm also grateful to all the panelists and the audiences for taking time out on a holiday, and a very happy Independence Day to all of you. Let me now quickly share my screen for the presentation. And my apologies, because of the bandwidth issue, I may have to switch off my video. Just give me a moment. Saugata and I are going to discuss the global economic trends and how COVID-19 has impacted these economic issues and how it has impacted policymakers across different nations. So, to start with, we first have the fundamental economic question. Is COVID-19 a demand or a supply shock, or is it a combination of both? In order to understand this fundamental principle, we start with the shock decomposition for March 2020 for United States of America. If you can see here, the horizontal bar indicates various sectors in the US economy, and the red bars indicates the supply shock, and the blue bars indicate the demand shock. The size of the red bar relative to the blue bar shows how important supply shocks are as compared to the demand shocks. So when we say a demand shock, what exactly is it? A demand shock is basically caused by declines in your consumer spending, increase in unemployment and the wage cuts, and uncertainty about the pandemic. It basically hampers the consumer's ability to purchase goods and services. It's as simple as that. The supply shock, on the other hand, is caused due to lockdowns and shutdown of the sectors, migration of labor, and disruptions of global supply chains. Now, as you can clearly see here, for most sectors, the decrease in economic activity was majorly due to the supply shock, almost 66% compared to the demand shocks. While most sectors experience negative supply shocks, as you can see here, the leisure and hospitality has the biggest red bar, which is the supply shock here. There are two sectors that actually faced a positive demand shock, and that is retail trade. And of course, information sector is benefited likely due to the increased interest in telecommuting. Now, this data and statistics clearly indicate that COVID-19 is a combination of demand and supply shock. It's a simultaneous shock wave to the economy and these sectors. Now, how does that simultaneous shock affect the countries? Are we heading towards stagflation? This is one of the pertinent questions that all policymakers, all economists across the world are trying to analyze. And in order to understand that, let's go back to the basics of the fundamental principles of demand and supply. There are two hypothetical scenarios. One is where your demand shock equals a supply shock, in which case, if we start with an equilibrium situation, wherein your aggregate demand curve is a downward sloping blue curve, and your aggregate supply curve is an upward sloping red curve, with an equilibrium price of P1 and equilibrium output or real GDP of Y1. So what happens when there's a demand shock? Your aggregate demand curve reduces from AD1 to AD2. Your aggregate, and because of that, your aggregate output reduces at equilibrium from Y1 to a Y2, and your prices also reduce. However, what happens when there's an equal supply shock? In that situation, while it reduces your output, it increases the price levels. So net effect is that there is a recession because there's a decline in real GDP, but the price, the equilibrium price may remain constant because there are opposing forces. And therefore, it is a situation where there's recession, but stagnant prices. Now, let's take the situation linking it back to the US economy, where the supply shock is actually much larger than the demand shock. That's actually even a more dangerous situation that we are in. In that situation, what typically happens when your aggregate supply declines more than your aggregate demand, while your output or real GDP declines, at the same time, your prices also increase. So what we are seeing is a recession coupled with inflation. And that is an extreme economic situation where there is a decline in your output, there's an increase in inflation, and there is increase in unemployment. Because of all these factors combined, um, what you see is a stagflation scenario. Now, this is a fundamental concept. In the next couple of slides, we'll try and analyze whether, in effect, based on the current statistics and economic trends, is the world heading towards stagflation or not? So there are three factors, as I said, for stagflation. One is GDP, second is inflation, third is unemployment. Let's start with GDP forecast. As you can see here, the dark blue bars indicate IMF forecasts for GDP for 2020 before COVID-19. That's around January. The light blue bars going downward indicates the GDP forecast for all these countries, including the world, after COVID-19, which is around June 2020. And as you can see here, all the countries are expected to show a negative GDP growth rate. The overall world is expected to grow at negative 4.9%, except one country, which is China. It's the only country that IMF projects to have a positive GDP growth in 2020. Let's understand the unemployment trends now. A prolonged decline in the economic activity, extended lockdowns, and firm closures, all these have actually resulted in a sharp increase in unemployment in April and May for India and US. Even the forecast for unemployment continue to be very, very high. For India, for Q4 2020 is about 15%. For US is as high as 16.9, and for Euro area is 11 to 12.6. India's unemployment reached a higher level in April and May. That's because of the nationwide lockdown that got extended. However, if you see here in June and July, it went down because of the government's national rural employment schemes, which helped in controlling the unemployment to some extent. We look at the third factor, which is inflation. Very quickly, currently, these are the drivers of inflation or deflation. Factors that increase prices are the government borrowing and stimulus packages, any trade tensions internationally, and global supply disruptions. Factors that reduce inflation are high unemployment, lower economic activities, and lower oil prices. As you can see here, the two bars here, sorry, my apologies. The two trend lines here indicate the advanced economies and the developing economies. So in actual CPI till date, average inflation in advanced economies had dropped about 1.3 percentage points to 0.3% year over year as of June 2020, while the emerging market economies had fallen by 1 percentage points to 4.4% year over year. That is the actual impact. The reason why this has happened is because the downward price pressure from decline in aggregate demand, together with the effect of lower fuel prices, is offsetting any upward cost push pressure from supply interruptions. And therefore, you'll see in 2020, there's actually a slight decline in the inflation. If you look at CPI general index for India, inflation continues to remain above the Monetary Policy Committee's tolerance band of 6%. And in just few minutes from now, we'll have Saugata sir commenting on what is the likely monetary and fiscal policy in the given scenario. But coming back to our discussion, what is the conclusion? Are we heading towards stagflation or not? We know that stagflation is decline in GDP, increase in inflation, and unemployment. Fundamentally, this contradicts the famous Keynesian-Phillips curve trade-off between unemployment and inflation. This trend is commonly seen in several countries, to the extent that as an inflation increases, the unemployment declines and vice versa. But the stagflation scenario contradicts the Keynesian-Phillips curve. Have we actually seen stagflation in practice? Yes. In the mid-70s, US faced a prolonged slump with high unemployment, including rising inflation, but that was partly driven by the oil prices. So the conclusion is that we may not have actually entered stagflation as of now. Yes, there's a decline in GDP across the globe. Yes, there's an increase in unemployment, but the inflation is not likely to increase. The US economic growth between 73 to 75 actually saw 5 quarters of consecutive negative growth and tripling of inflation to be regarded as stagflationary phase. What is the likely recovery of the consumer confidence? As you can see in the graph here, in the chart here, the light yellow countries indicate a fairly quick rebound, which is China, which is Australia. The orange indicates a slow recovery here, and the red indicates a sustained period of depression, which is United States. On that note, I now move on to Saugata. So, what are your views on the COVID impact on the global real GDP growth forecasts and aggregate demand, especially in light of the likely trade-off with the inflation and unemployment trends in the developed and developing economies of the world? Also, your views on the likely recovery of the developed countries like USA in contrast with the recovery of India, whether it's going to be a V-shaped, U-shaped, or somewhere in the middle. Over to you, Saugata.
So, now, thank you very much for having me on this program. First off, congratulations once again to the ELP team for their inclusion in the arbitration index. I think it's a magnificent achievement. I mean, my heartiest congratulations and compliments. Namrata, thank you very much for your kind introduction. So again, I mean, Mrinal, you showed, I mean, the deep contraction that the IMF estimates in many countries. So I will not go. I mean, you had a very comprehensive presentation. I just want to point out a couple of things to show you how intensely different this crisis is relative to all the other crises in the past. So IMF, as you showed, is showing a -5% contraction of global growth in 2020. Contrast that for perspective from the immediately following the global financial crisis in 2009, when global GDP contracted by only about -0.07%, less than 1%, right? This is -5%. That's one. Secondly, global central banks, I mean, the response that you have talked about as part of the monetary fiscal stimulus. So the monetary stimulus from global central banks, the big three, the US Fed, the European Central Bank, and the Bank of Japan. So before the financial crisis in 2008, the amount of money that these central banks had printed, their balance sheet, so to say, yeah. So that before the crisis in 2008 was about $4 trillion. Over the course of responding to the financial crisis, and all the way up to February 2020, just 6 or 7 months back, the balance sheets had gone from 4 trillion to 14 trillion. From February 20 to August 20, the balance sheets of these three central banks, the large ones, has gone from 14 trillion to 22 trillion. So that's wow. $12 trillion, $10 trillion over the course of 12 years, and $8 trillion over the course of 5 months. Yeah, so that's the extent of response that the global central banks, at least, have given. As a consequence of this, there's come about a very peculiar disconnect between real economic activity, the things that you showed, -5% contraction, and the state of the stock markets. I mean, stock markets have zoomed all over the past. So the peculiar thing is, I mean, if you take a sort of a recession in the stock market, sort of bear market, which is, if you can define that as a drop of 20% from prior levels, from February 2020, the S&P 500 in the US, this has been the fastest recovery. I mean, has made up that entire 20% loss in the space of about 5 months. Not even that. I mean, even lower than that. The shortest recovery before was in 1982, which was about 8 months. The similar 20% drop. And finally, in the global financial crisis, the global financial crisis in 2008, it took 5 years for the S&P 500 to recover that 20%. So just shows you how various markets, behavior, etc., has become completely unhinged, and the kind of response that you need to provide. So that's the global side. Coming back to India, as you were saying, so our expectation is that India's GDP will contract. IMF, as you showed -4.5. We think anywhere between -6%. Nobody really knows. Depends on the extent of the infection spread, the virology, etc. So anywhere into double digits, -10, -15. We are still sticking with -6% as of now. But more importantly, and again, I mean, recovery. recovery in the US, recovery in India, and very coincidentally, US and India are the two most intensely COVID affected countries.
Right.
So recovery, pretty much everybody now expects that you're not. I mean, so immediately after the drop that you showed in the first quarter, you will have a recovery back to some levels in the second and the third quarters, but nobody expects recovery to be very quick. In India, there are multiple reasons why you would tend to expect that recovery. Consumer, there's a huge amount of uncertainty. Not just that real GDP growth contraction of -5%, -6%. We are likely to see an overall income loss of anywhere between 20 to 30 lakh crores in India in FY21. 20 to 30 lakh crores. By the way, our GDP is about 200 lakh crores. So that's 10 to 15% of the GDP gone. So given this, there will be a huge change in consumer behavior, huge change in uncertainty. Consumers had leveraged a lot with the NBFC boom over the last 3 years, so they will not take on any more debt. Given all of this, and a similar situation also reigns in the US, similar. So given this scenario, that nobody really expects a very sharp recovery. Everybody talks about the Nike swoosh, the check mark,
Right.
sharp drop and then go forward.
Right. Thank you, Saugata. That was very helpful and insightful. Um, I move on to a related concept of global consumer confidence index, and I managed to get hold of this article, the conference board, which actually gives you region-wise impact on the consumer confidence. And as you can see, North America is the worst hit with a change of -20 points, followed by Asia and Latin America. India, as we can see here, is at -17 points. And this change that we're talking about is from Q1 2020 to Q2 2020. And Saugata, as you rightly said, that consumer confidence is one of the key elements in the overall economic policies that the governments are likely to now introduce. So in that context, do you expect a significant change in the structure and the form of the consumer behaviors going forward in the short term to long term?
Yes. So to carry on the conversation, I'll keep this very short this time, unlike the first one, which was the context setting. So consumer behavior will change, not just consumer behavior, consumer, investor, corporate behavior, everything will change. Consumers first, as I mentioned, I mean, they're already piled on a fair bit of debt, particularly from NBFCs. And given this vast uncertainty in cash flows, uncertainty in salaries, uncertainties in incomes, all of us, I mean, put ourselves in the average consumer's place. So nobody is going to spend big ticket money anytime in the near future. That will lead to corporate behavioral change, because corporates already, I mean, capacity utilization is very low, as RBI data just recently showed. So till you actually see visibility in demand, in consumer demand coming back, nobody is going to, private investors are not going to go rush into building new capacity. Global investors are, on the other hand, are very picky and choosy. I'll take that separately in one of the later sessions. They have become very picky and choosy because the nature of this crisis will lead to massive changes in patterns, in corporate behavior, corporate investment, some sectors, the winners and the losers of the segment. And that will have a key impact on the pattern of investment that will go forward.
Sure. Noted and understood, Saugata. Expansionary monetary policy. I mean, this is something we can't avoid. This has affected all the economies across the globe. And as you can see the graph here, it shows the interest rate cuts, or the current interest rates in different countries: Japan, US, Germany, and India. As you note here, India is currently at 5.9%. These are the 10-year government bond yields. In technical terms, the interest that we talk about is actually the yield to maturity on the long-term government bonds that we refer to. And the objective of these monetary policies is to provide an immediate impetus to the tumbling financial markets and stimulate demand in the medium to long term. Now, before we move on to analyzing this data, it's just a fundamental explanation of the price of a bond and yield to maturity, that there's an inverse relationship between the two. And it's important to understand why we observe a decline in interest rates or yield to maturities across the globe. So first, yes, as prices of the bonds increase, the yield to maturity declines and vice versa. In my view, there are four reasons for decline in the long-term yield to maturity of these government bonds. The first and foremost is that all the investors are fleeing from the volatile markets and they seek shelter in the safe haven government bonds. What this does is increase the demand for these government bonds, pushing the bond prices up and resulting in a decline in the yield to maturity. The second is the unprecedented asset purchases by the government. And when I say asset purchases, these bonds basically it refers to purchasing of these bonds by the government in the open market. Again, having the same impact of pushing the demand for these government bonds up, pushing the prices up, and therefore decline in the yields. The third reason is straightforward. There's a direct announcement by the policymakers and governments for interest rate cuts, which has happened in India, which has happened in several countries across the globe. And the final, which is an interesting one, is the inflation. Now, inflation does impact the bond's future cash flows. It actually erodes the purchasing power of the future cash flows. So very simply, the fundamental relation is that the higher the expected future rates of inflation, investors will obviously demand a higher yield to compensate for that inflation risk. We have seen earlier that inflation is actually either stagnant or in a declining trend for 2020 because of this COVID. What this does is that if the inflation is low, investors would be ready to accept a lower yield on the bonds. And this is one of the reasons why globally you will see that the interest rates or the yield to maturity on these bonds are declining. A very interesting aspect of Germany I would like to highlight here. My apologies, the circle is actually not on the correct figure here. It should be on negative 0.5% that I want to highlight. Germany in the dark blue has actually a yield to maturity of a negative 0.5%. What that means? Basically, if the total amount of interest that the bond pays over its remaining lifetime is less than the premium the investor pays for the bond, for purchasing that bond, the investor is actually losing the money and the bond is considered to have a negative yield. So why would any investor invest or purchase a bond with a negative yield? The answer is simple, because they're desperate for safe haven assets, and they are betting on the fact that further decline in yields will increase the value or the prices of bonds in future. On this note, Saugata, it's pertinent to know your view that what should be the appropriate fiscal and monetary policy response to this current situation we are in emanating from COVID-19.
So again, coming back to Naresh Saab's description, I think that was a very precise description that the entire response of the government and the RBI in India, the fiscal policy and the monetary policy, has been premised on this strategy of survive, revive, and thrive. So the first set of measures from the government, Prime Minister's address and then Finance Minister's, the string of measures that she announced, following the first, the actions of the Reserve Bank of India, were essentially to make sure that companies did not go under because of their because it was not a lockdown in April, it was a shutdown. Everything was shut. So cash flows disappeared. So as a result of that, the first set of measures were devised more towards that survive phase. In the last the week before the prior week, when you saw the RBI policy, there was a clear transition from survive into revive. The one-time restructuring thing, so banks were allowed. So now stepping back a little bit, the government pretty much, because of the lack of incomes, their tax revenues have come down. You cannot issue too many bonds in the market. The numbers are quite frightening. As you showed in your chart, that the 10-year yield is 5.9%. The last inflation print that we saw was 6.9%, right? So you are getting a negative 1% even in India. Now, if you were to hold a 10-year bond, so your real nominal interest rates minus inflation is minus 1%. Yeah, so that's the kind. So interest rates have pretty much run their course. Nobody will be able to use interest rates. So the focus now will need to be on credit revival. So for this revival phase, the thing that needs to move forward is bank credit. There has been some movement, the guarantee scheme for MSMEs, the 20% additional credit that will be guaranteed by the government, that has taken off. More than 1 lakh crores have been disbursed to MSMEs, but overall credit is not moving. So that is the focus of the revive phase, and then moving on into the thrive phase, as Naresh Saab said. So the using the one-time restructuring, using the IBC process separately, etc. That will now be the focus to get growth going forward in the next couple of years.
I think I agree with you, Saugata. I think the governments of all these countries have exhausted interest rate cuts as a monetary policy tool, with so much of pressure on these, the downward pressure on these cuts. I mean, US hit its low at 0.3% sometime in March and April. So I'm sure there's no more cushion left to use this as a policy anymore. Completely agree with you on that point. Very quickly on the Purchasing Managers Index, it's a measure of prevailing direction of economic trends, and a measure above 50 indicates expansion compared to the previous one. And as you can see here, that China factory activity shrank fastest rate on record in February, but faced a quick recovery in March 2020. However, as the rest of the world began to feel the economic costs of the pandemic from April onwards, the manufacturing and services activities stalled, registering highest declines on record. So you can see here different bars, which represent the months January to July. And as you can see, India services PMI and India manufacturing PMI showing a decline and then a recovery in June and July. The question here, Saugata, is in particular, what role now could the banks play in reviving this weak credit demand and overall, investment confidence, especially given the massive surge in the non-performing assets in the current situation that we are in?
Let's keep this one brief. I've just touched upon this. So bank credit, because I mean the government does not have any money to spend directly. I mean, it is using guarantees, backstop, other types of contingent support in the system to try to make sure that the amount of risk aversion, and this risk aversion had started much before the COVID crisis, right from the ILFS days in 2018. So there was an enormous amount of uncertainty about particularly the NBFC segment, and banks had taken up some of the slack. And that is probably what will be the key driver. So two things are happening in terms of credit. You would have read that all the private sector banks are in the market to raise capital. Massive amounts of capital are being raised to shore up the tier one capital, as it's called, of banks, to make sure that, I mean, whatever the stresses that arise in the system, banks are adequately capitalized. The second part is because of the RBI infusion of liquidity. All the rates, you showed the long-term rates, the 10-year rates. What has happened after the RBI intervention is all the short-term rates have collapsed. So, I mean, so it's nearer to the reverse repo rate of 3.35%. So you get 3-month money, 3-month bonds at 3.5% now, and the 10-year money at over 6.5% to 7%. So that's the change that has happened. So there's been an enormous amount of bond issuances, not banks. So one part is banks providing, I mean, capitalizing themselves to prepare for the next credit cycle that is coming up. And the bond markets are becoming more active to provide more credit. However, this is only to the better rated corporates. That needs to be brought down to this double A's, single A's, triple B's, etc. So that's the next step in the monetary, fiscal, and other policies that should come.
Sure. Thank you, Saugata, for those views. World Merchandise Trade Volume Forecast. As we can see here, WTO, there's an optimistic scenario and a pessimistic scenario for 2020 and 2021. The WTO forecast for global merchandise trade in 2020 is actually a negative 13% in an optimistic scenario and a negative 32% in a pessimistic scenario. What does the optimistic scenario say? Well, a strong rebound is likely if business and consumers view the pandemic as a temporary, one-time shock. In which case, the consumer spending and investment expenditure is going to resume close to previous levels. Very quickly, the trend line for the world merchandise trade. Going back to the 2008-9 crisis, as you can see the small graph on the top left corner, after the financial crisis of 8-9, trade actually never returned to its previous trend. If you can see that over here, the gray dotted line, that is the previous trend line, and the trade never returned to that level. What is the situation now? If you look at the bigger graph here, in first quarter of 2020, there was a 3% year-over-year decline in the volume. In the second quarter, initial estimates indicated a year-over-year drop of around 18.5%. The fall in trade we're now seeing is actually historically very large. In fact, the steepest on record. But in the light of the available trade data for the second quarter, one thing is clear that the April forecast of the pessimistic scenario appears less likely, since it implied sharper declines in the first and second quarters. On this note, Saugata, my last question to you is, could you please elaborate on the cross-border trade investment trends, the treatment of foreign exchange, and in your view, will the world merchandise trade volume today ever return to its pre-COVID trend? If yes, what are those measures that are required to achieve that target?
Yes. So again, I'm not going to address this directly. So a couple of points. Trade, of course, has been hit very hard. And as you said, so unlikely to recover to pre-COVID levels for some time. But together with this, trade now is not just trade in goods and services. There's a large investment component. I mean, trade and investments are very tightly linked together now. So what has happened is, this is a trend even before COVID. A lot of companies have been looking to reduce their concentration risk concentrated in China and try to expand out of China. So we should be going all out to see how much we can get of that ex-China business, the China +1+1 strategy. How much we can do. It's not likely to be easy. However, we've got a significant amount of foreign investment. Remember that India is still a very good macroeconomic. Foreign investors think India is still a very good macroeconomic story. The chart that you showed, they're getting -2%, 0%, 0.1%. So obviously they are looking for India to provide them that boost that they reach for yield. We are open for business. Second, there is a major change in India post-COVID, which is the trend in digitalization. So all the businesses that will come in, it's now not just trade in goods and services. Now there are agreements getting signed on trade in data. Yeah, so data has become a very, very powerful commodity. So that's the second feature that will happen. The third feature, which is where I want to stop and highlight the link between economics and law, is that the post-COVID, there will be a massive change in the winners and losers. So based on this digitalization, on the data generation that's likely to happen, you've already seen $21 billion flow into one company in India in 3 lockdown months. Yeah, so that's the kind of interest that will come into India. So there will be clear winners and losers. Unfortunately, this thing will accelerate the trend now. COVID crisis will accelerate the trend of consolidation within industries. So each and every industry in the world, not just in India now, is becoming a monopoly or a duopoly or an oligopoly, max to max 2 or 3 or 4 large companies in the segment. What does this imply? Competition is beginning to come down. Competition law is going to reign supreme, and together with competition law, Naresh Saab, your business is now cut out for you. Arbitration, the kind of disputes that you've already seen in Europe with all the big data companies. Yeah, the DG4, the Directorate General 4 of Anti-Competition in Competition Directorate in Europe. That will spread all over the world, and that's where I want to stop on this. Thank you.
So there are 4 arbitration lawyers here. We are all smacking our lips, in absolute anticipation.
Thank you so much, Saugata, for your views here. I'm done with my presentation here, Namrata. Back to you. Happy to
And
address any questions in the end.
speaking of arbitration, we have our next two speakers, both arbitration practitioners, Sherina and Abhileen. And so, in light of what we've just discussed, Sherina, in a post-COVID world, do you see an increase in the number of arbitrations and investor-state disputes, or do you think that cases are more likely to go to mediation and settlement instead?
Thanks, Namrata, and thank you, everyone, and particular thanks to Mrinal for organizing this fantastic webinar. Namrata, in answer to your question, let me first touch upon international arbitration, and then I'll move on to the other parts of your question, which is investor-state disputes and then mediation. I think when you look at the international arbitration scenario, in the short term, there's likely to be a spike in disputes in industries that are most affected by COVID-19. So, for example, industries like construction, aviation, insurance, shipping, energy, and I'll touch upon some of these later. In the long term, however, the COVID-19 pandemic, I think, is likely to lead to a significant rise in international arbitration disputes due to its ripple effect across sectors and global supply chains. Mrinal and I were actually liaising with the Director General of the HKIAC, Sarah Grimmer, to generally assess the trends in the first half of 2020, reflective of the post-COVID scenario compared to the second half of 2019, which was actually reflective of the pre-COVID-19 scenario. And the response actually from HKIC was extremely interesting, and I thought, therefore, I should incorporate it into my response to your question. So in total, for example, in relation to the total number of cases in the first half of 2020, the HKIC said that they were at par with the total number of cases in the second half of 2019. And it is important actually to note in this context that 2019 was a record year for case filings at the HKIAC. In terms of emergency arbitrator cases, there was a notable increase in emergency arbitrator cases. Actually, the HKIAC said that they witnessed 3 emergency arbitrator cases in the first half of 2020 compared to 0 in the second half of 2019. And of the 3 in the first half of 2020, 1 of them actually had an express COVID-19 connection. We then asked the HKIAC about the total amounts and total sums in dispute. And apparently the total sums in disputes were higher in the first half of 2020 as compared to the second half of 2019, which is obviously very, very interesting when you look at these statistics. There was no significant changes in the top 5 foreign users in the first half of 2020 compared to those in 2019. And we asked who were the top 5 foreign investors who were non-Hong Kong in the calendar year 2019, and they were mainly from mainland China, BVI, USA, Cayman Islands, and Singapore. And lastly, in terms of the breakup of sectors by dispute, the HKIAC said that there was no significant change in the top 5 sectors in the first half of 2020 as compared to 2019. And so we asked, so what are the top 5 sectors, and can you give us a bit of a breakup? International trade was 34%, banking 11%, maritime 14%, construction, interestingly, was 15%, corporate was 17%, and other sectors made up about 9%. And I'll touch upon some of these sectors later on in this webinar. I know time is short, so I'll move on to the second part of your question, which was about the investor-state dispute scenario. I think one can expect an increase in investor-state disputes tied on one hand to governmental measures taken to tackle COVID-19, and on the other hand to likely changes to tax and licensing regimes, particularly in emerging economies and around the commodity sectors. I think as growth markets are hit by economic impact of the pandemic, it's more likely that the governments will tighten the rules around project profit sharing arrangements for foreign investors and allocation of and extension of licenses for private foreign investors active, particularly in the natural resources sectors. So given the likely increase in the new cases and the pandemic's effect on national economies, I think it is likely that we will see some reforms to the legal frameworks around investor state claims, possibly thanks to the cooperation of governments and think tanks. So for instance, one can observe the recent calls by established think tanks for a moratorium on all new investor state claims, even if they are unrelated to COVID-19. Now, of course, the counter argument to all of this could be that it is likely that there will be a spike in pandemic-related investor state arbitrations as the investors will be worried of potential increased arbitral deference to government regulatory measures. Two would be the consequences of the global economic downturn on damages calculation. And the third could be the negative public relation perception associated with suing those that are fighting to protect public health and safety. But I think one can't forget that when discussing investor state disputes, it's fundamental to remember that these claims tend to take a very long amount of time to actually crystallize and even longer to reach resolution. So in the climate of economic uncertainty and strained cash flows, it's likely that there will be many contenders to pick up it's unlikely actually that there will be many contenders to pick up an investor state claim by themselves. And that's when you come to third party funding, because it's likely that it could be funded by third parties. I personally have seen a spike in the number of potential inquiries coming in from clients and from funders to assist with these types of cases. Third-party funding, companies are likely to rely on this third-party funding for dispute resolution, including buying and selling of claims. Because why? Because they want to preserve cash and they want to choose to deploy it for operational rather than contentious purposes. It may be interesting to also see that we may see some new entrants for the funders from perhaps China, the Middle East, and Eastern Europe, which are the cash-rich investors, have come to recognize that returns from dispute resolution recoveries can be just as promising as those from other forms of distressed asset investing. And now let me just touch upon the last part of your question, which was the increased use of mediation. I think thanks to the factors that I have discussed, strained cash flows, economic uncertainty, and the sheer volume of pandemic-induced claims, many of the claims which are now materializing are likely to go through mediation as a more cost-effective dispute resolution method than full-blown arbitral proceedings. Contracts generally prescribe for a formal, lengthy, costly mode of dispute resolution like arbitration. In the current crisis, the overriding desire is really for companies to resolve their disputes in a swift, but actually a fair manner. And when I was talking to my clients, it's a consistent message across the board. They have all been encouraged to avoid COVID-related disputes, not least because actually the courts themselves have a huge backlog of cases that are caused by the pandemic. In fact, one of my clients, who's a major large Indian conglomerate, said to me that they've got a diktat from management that they must try to settle everything through mediation. Interestingly, Steve Bratt, who's a member of the Construction Leadership Council of the Coronavirus Task Force in the UK, pointed out that the construction, infrastructure, and facilities management sectors had hundreds of small businesses linked by complex supply chains, and therefore companies should look at the bigger picture and encourage fair contractual behavior. And this was then reflected in the new guidance from the Cabinet Office in the UK, which urged groups to act reasonably in enforcing their contracts in light of the growing concerns that COVID-19 will cause a spike in law firms and create a backlog in the courts. Similarly, the British Institute of International and Comparative Law also recognize that the international dispute resolution system, whether it's via courts or arbitration, is likely to come under considerable strain in the coming months and maybe years. So the response was to create something called the Breathing Space Project. With the help of senior former judges, they are calling for new measures to resolve disputes and have actually suggested conciliation and to encourage conciliation. Another trend that I've seen is online mediation as well as fast-track dispute resolution solutions. These are all attractive to clients facing financial difficulties. The significance of mediation is as an attractive tool for litigation or arbitration is also recognized by the senior members of the English judiciary. So, for example, in the UK, Lords Newberger and Lords Phillip have called for commercial disputes to be resolved by mediation and other ADR mechanisms to avoid a deluge of post-COVID litigation. So to end, in the current climate, I've seen some new products that have been developed to assist companies in resolving the disputes. One such product is by the London Chamber of Arbitration and Mediation, which has launched in the market offering expedited arbitration and mediation services through electronic means for a fixed fee, which is delivered by a diverse expert panel of arbitrators and mediators. My firm, Norton Rose Fulbright, has also developed a product, and that's called the NRF Resolve. The framework is, it's an expedited legal framework for dispute resolution that's administered through an online platform, which is supported by a Norton Rose Fulbright caseworker, along with a Norton Rose Fulbright partner or a pre-approved third party. So that could be a QC, etc., who could act as conciliator and mediator. And the idea is to facilitate an expedited arbitration or mediation within a time frame of 5 weeks. So I hope actually that's taken you through all the questions that you've asked me, Namrata.
Thank you, Sherina. And turning to Abhileen, Abhileen, in your experience from a dispute resolution perspective and in the Indian context, how have foreign investors responded to the various measures that the Indian government has taken to deal with the pandemic? Abhileen, I think you're on mute.
Yeah. Thank you, Namrata, for the question. And as of now, see, there aren't many instances where a foreign investor has taken the government of India to a treaty arbitration situation when it comes to COVID. But globally, in the recent past, there have been certain trends, and there have been situations where investors have threatened threatened governments with treaty arbitrations. To give you an example, recently the government of Peru was threatened with the treaty arbitration because of certain concessions which they had given to a road concessionaire being stalled in light of COVID-19. The reason behind relaxation of toll taxes was so that the movement of essential services could be expedited. And the road concessionaire, who was supposed to take a share of these toll taxes, has perhaps threatened the government with a treaty arbitration. There are instances against Zimbabwe. Again, it's not a treaty situation. It's an LCIA arbitration which may be invoked by the investor. Again, that's for supply of COVID-19 testing kits. The contract was terminated because of corruption issues. And now the investor is indeed threatening the government with treaty arbitrations. And just to touch upon what Saugata said, there will be a loss of perhaps 15% of GDP when it comes to a country like India. Now, to arrest that, there will be definitely policy changes within the government, within the Indian context as well. And only time will show how these things will perhaps be questioned by investors in the future. Right now, well, all corporates and all investors are cash strapped, and litigation requires money. Maybe once everything starts rolling, we'll have instances of these in the future. But right now itself, the world of treaty arbitrations is not untouched by COVID-19. As recently as during this week itself, the government of Spain challenged the tribunal's decision for holding the hearings online. They said that there is no cogent reason cited by the tribunal for holding the hearings online when the hearings can be conducted in person. And they have apparently challenged the tribunal itself because of this procedural direction. Now, this is a challenge which will eventually be tested by the Secretary General Dixit. It's an ECT case, and we will only see how the challenge goes into the future. Apart from that, there are concerns around the state policies which will be taken in order to meet the COVID crisis. There may be travel restrictions. There may be restrictions on movement of capital also. Now, as has been discussed already, there will be shortfall in funds for developing economies. Now, there may be policies which are introduced to to transfer the funds from India, within India, outside from India to outside India. Now, these are all measures which in the past also have been taken to treaty situations. Issues like nationalization, um, when governments have taken over private enterprises, those have been taken to treaty situations. And investor treaty arbitrations per se are not exactly a very charitable situation. Governments have been questioned for measures which have perhaps been the most noble in their nature. Australia was taken to treaty arbitration for a plain packaging measure. Um, Spain has been questioned in so many arbitrations for changing from thermal energy to solar. Germany has been questioned in so many arbitrations because of movement from nuclear energy. Then Argentina was questioned in so many arbitrations in order to address the peso crisis of 2008. So right now, according to me, we are just seeing the tip of the iceberg. All these questions which are being raised in treaty setups, they are very, very preliminary in nature. And as Sherina said, there are more and more queries on third-party funding. As soon as an investor or a corporation feels that there is the slightest merit to a case, there will definitely be arbitrations against governments, and unfortunately so, it will be a great damage to the economy of a developing country, because as it is, there is a shortfall of earnings for countries because of this crisis, and future arbitration may just make them spend more.
Thank you. Thank you, Abhileen. You touched upon the objection to online hearings. And I wanted to ask you, what has been your experience with virtual hearings in domestic arbitration and litigation in India?
Oh, so I can safely say that during the month of March and April, everybody was sort of in a state of shock. There was hardly any movement, but as you progressed in the months to come, everybody realized that this is the new normal, and everybody did take up things. And of course, this is the movement in arbitration cases is majorly dependent upon consent of parties. Simple things like cross-examination is something which does require consent from both the parties. And there have been concerns raised on tutoring of witnesses while cross-examinations are going on. Now, those are certain things which can be addressed in any setup. If you feel that your witness is perhaps going to see something else on his screen, you can have cameras behind him or have a camera in front of him. So it's not like these things cannot be addressed. We've had procedural hearings, we've had evidentiary hearings. Right now, we are in an arbitration where final hearing of the entire proceeding is going on. It's a very, very volume-heavy arbitration, and the tribunal has expressed its difficulty in getting all these papers together, but they have been more than amenable to adapt to technology. They have been asking us for papers over e-platforms, so on and so forth. As far as cross-border arbitrations are concerned, we have recently conducted a jurisdictional hearing in the month of May. But then again, these sort of hearings were conducted in the past also, where the tribunal members were scattered all over the globe. We were lucky enough to do an arbitration where one arbitrator was sitting in Australia, the other one was in the UK, one was in Dubai. And luckily enough for us, it worked out perfectly well because the hearing was in the evening for us. For the UK person, it would have been in the morning, and for the Australian arbitrator, it would have been much late in the evening. But as far as cross-border arbitrations are concerned, institutional arbitrations are concerned, these things have been there in place, and the technology will definitely develop more as we progress. As far as domestic arbitrations are concerned, we have seen a major change in the domestic tribunals, who have been more than amenable to adapt to the new normal and conduct proceedings as normally as possible.
Your arbitration sounds like a day in Sherina's life, where she's in 3 different time zones at the same time. Sherina, can you elaborate on the role of technology in international arbitration?
Sure. So in my opinion, I agree with everything Abhileen has said. In my opinion, before COVID, arbitration and technology had a somewhat ambiguous relationship, I would think. Although arbitration has been historically associated with technological progress and innovation more than litigation, I think in practice, many practitioners have rarely actually used remote hearings. The reality was that most of the practitioners and clients preferred physical hearings. I preferred physical hearings. Sometimes, of course, there was a remote element to it where, you had a witness dial in or, an expert. But I think it's fair to say that most of us, for most of us, the e-arbitration world has been a steep learning curve, and Naresh called it was no longer the new normal. The adoption of the concept of virtual hearings is visible by the unsurprising sharp increase in the number of partially or fully virtual hearings by arbitration institutions around the world. And I think that's obvious because of obviously the world we're currently living in. I will now briefly discuss, I think, some of the best practices around virtual hearings and some of the key changes brought about by technology to the practice of international arbitration. As I mentioned previously, most arbitrators were unfamiliar with virtual hearings. Whilst they may have experienced some sort of cloud-based document sharing and video conferencing, I was reading a really interesting survey by the Queen Mary University 2018 arbitration survey, and they found that 78% of arbitrators had never or only rarely taken part in hearings where all participants were in different locations. The statistics have obviously hugely changed, and the coronavirus pandemic is requiring the arbitration community to rapidly adapt to a reality which will be with us for the short or medium term. And virtual hearings is now the new normal, or as Naresh said, the normal. It's worth noting that courts around the world have recognized the importance of virtual hearings as well for the proper administration of justice. So looking at England, the English High Court and the Court of Appeal is continuing to hear all urgent matters, and now generally more matters. And the London Commercial Court also released a statement highlighting that the court's approach should be optimistic rather than hesitant, and that it is the duty of all the parties to seek to cooperate to ensure that a remote hearing is possible. Parties should be encouraged, obviously, to consider the ramifications of virtual hearings in advance. So in fact, in an arbitration where I am counsel, we've already been asked by tribunals to consider the ramifications of the global pandemic on a week-long hearing that is slated to be heard mid next year. They've asked us to make suggestions in respect of this and how should it be handled by the tribunal. The parties have conferred and identified that actually if the hearing next year was to be fully or partially a virtual one, then one option would be to use the virtual hearing platform that has been developed by the service provider already engaged to provide courtroom and document management systems. In the circumstances that there's a physical hearing, we are discussing whether to reserve an additional breakout room and hearing rooms for hearing dates to be able to comply with social distancing regulation, reserving an additional week for the hearing to take into account delays if some witnesses are required to give evidence by video link. And we've actually asked the tribunal from now to reserve this additional week. The parties, of course, will assess nearer the time whether we need a full virtual hearing or not, or a full in-person hearing. But the measures are being put in place now, and that's the crucial point. I think a few actions that parties can take to ensure that they adopt best practices for virtual hearings, and this is, I'm talking through experience. One is consider obtaining an agreement by all parties involved that the fact that the hearing is being conducted virtually will not be used as a ground to challenge the result of the hearing, because there's no point in going through an entire arbitration and going through all of this hearing if ultimately you're going to have a paper reward in your hand, which is unenforceable. The second is select an appropriate video conferencing platform in advance, which provides robust protections for confidentiality, offers high resolution video imaging and quality audio, and enables participants to display documents on the screen. The third, I would think, is to usefully retain a third-party service provider to arrange, to monitor, to support, and to troubleshoot the video conferencing system. And I found this really helpful in some of the hearings that I've been doing. The other thing that I found really helpful was to, particularly in relation to witnesses, to familiarize them with the platform chosen for the hearing and have suitable equipment to participate. So I would suggest that counsels for parties calling witnesses should consider conducting a test session with the witness in advance of the proceedings on the chosen platform and go through the electronic exhibits. Consider particularities of procedural laws, and you'll probably laugh if I say this, but for example, consider whether an applicable law authorizes the arbitrator to administer oaths to witnesses by video conferencing, and if not, determine a process to follow to ensure reliable testimony. Again, could go to enforcement of an award. Devise a process by which any participant who has temporarily lost an adequate connection to the chosen platform to promptly notify the arbitrators and other participants of an event and identify a backup plan. I actually dropped off a hearing that I was doing just as I was going to start my submissions. And thank God for WhatsApp and thank God for text messaging technology, because that's what I did with the 3 arbitrators. So if I were to pick up one of the pros of virtual hearing, besides obviously the obvious one of time and cost reduction, I think it would be the reduction of the carbon footprint as well. And in that sense, I think we need to thank COVID-19. In fact, Lucy Greenwood, who's an independent arbitrator, started a campaign for greener arbitrations last summer, which is now called the Green Pledge, where she noted the significant carbon footprint of the arbitral community and asked the community to pledge to try to reduce this through the use of video conferencing. I know that there's been a number of protocols as well, and I'm going to quickly wrap up. There's been a number of protocols and soft law instruments that offer guidance. And I would encourage participants to look at the ICC's Commission Report on Information Technology in Arbitration, the CIRB guidelines for witness conferencing, the Hague Conference Draft Guide to Good Practices, the Seoul Protocol on Video Conferencing. It's amazing the amount of protocols that are there to guide you. And I think institutions as well will be taking this up and probably providing guidance as well in light of the new normal. So thanks, Namrata.
Thank you, Sherina. Abhileen, one last question. Governments have been taking measures to cope with the economic crisis of COVID. And one of the measures that the Indian government has taken is to suspend IBC proceedings for 1 year. I just wanted to hear your thoughts on the long-term impact of that.
So see, right now, as the government has come out with the circular suspending IBC for defaults which would have been committed post March 25th for a period of 6 months, and then that may be increased subsequently as well. According to me, the real impact would be to a company after the lockdown, or after the pandemic, so to say, vanishes, or so to say, I mean, things become back to normal, because this is the period when companies will actually suffer economic harm. So the impact of which will only be seen after the entire crisis is over. So immediately, I mean, of course, it's a happy situation for a default which would have been committed perhaps before March or post March, and for circular, they are protected right now. But there needs to be more protection granted to a company which will suffer economic harm because of this pandemic. So maybe it's not something which can be factored in terms of period as of today. It may be something that the legislature will have to think how best to frame that particular policy. But the economic impact of crisis today will only come later on. And suspension of IBC proceedings during this time of crisis, yes, it's understandable, but there may be more reforms required when it comes to IBC on a later situation. Simple things. I mean, some of which may actually help the NCLT practice also. Simple things like when NCLT started at Bombay, there was only 2 benches. As of today, there are 5. So because there are no more new filings, maybe the backlog of cases eases. But that's on a lighter note. Having said that, according to me, the IBC situation will only get worse after the crisis. There will be companies who would have suffered heavily during this period. A hospitality company which is currently going through major economic harm because people are restricted to their respective geographies. They will only default on their loans or on their repayments after the crisis. So maybe it's not something which can be adjudged in terms of timeline. It has to be taken as per the effect which it has on a particular sector.
Right.
So,
Thank you, Abhileen, and thank you, Sherina. This takes us to our discussion on the impact on industries, and I'm going to hand over to Alok to continue the discussion.
before you do that, sorry for jumping in, and apologies for breaking the protocol. But on that last point, I just wanted to, we are talking about the suspension of IBC, and it's quite interesting. And from, I think, from a lawyer's perspective, you heard what Abhileen actually said. But I think more importantly, we should get the economist's view on, what this will actually do to the economy. And it will then have an impact on everything that, one does, whether it's ultimately coming down to law. I think it will have an impact there as well. My own sense, as I see it, is that, your NPAs are only going to increase for the simple reason that, those NPAs, those companies which ought to have become an NPA and declared an NPA today are now actually enjoying a sort of a moratorium. And you'll find, people running away with a lot of money. So issues far more than what, you're facing today will arise under these circumstances. I don't know what, Saugata has to say about this, or maybe Mrinal can pitch it. But I personally believe that from a economic perspective, this is far more harmful rather than allowing the IBC. If IBC had been allowed to continue, it would have done lesser harm than what stemming the whole process would actually do.
So this is Saugata. Let Mrinal take up this difficult issue, this thorny issue.
So I think what we'll do is we'll come back to Mrinal at the end of the session. and pose this sort of riddle and mystery to him, and hopefully he can unravel it with that brain of his. I'm actually excited to jump in. So Naresh, sorry about this, but I have two facets of my life which actually occupy most of my day. One is obviously arbitration, and construction arbitration being one of them. So we have Zarina there. And the second being, of course, media and entertainment, and Komal is there representing that facet as well. So very, very excited about this. Had thought of a lot of ways to introduce you to, but this was possibly what struck a chord with me. Komal, first off for you, thank you for being here, firstly. And second, in terms of the industry, we would like to understand, how was the industry pre-COVID? How did the media and entertainment industry actually make a living, if I may be so blunt? Komal, I think you're on mute, Komal. Sorry to interrupt you.
Thank you, Alok. Thank you. And before I begin, I'd like to thank Mrinal for organizing this webinar so wonderfully. The film industry actually has various streams of revenue. For a producer, he sells the theatrical rights. So there is theatrical revenue, and there is revenue from OTT platforms. There is also revenue from digital, the satellite platforms. So after the film was released in the theaters, 6 to 8 weeks thereafter, the film is either telecast on a satellite channel or is streamed on an OTT platform. So both happen. It depends which will happen first and which will happen second. And of course, there were music rights, audio rights for the producer to sell. For the exhibitor, it is the gate collections, what we call the box office. So pre-COVID days, that was on. Post-COVID or with the lockdown, of course, cinemas are closed. No films are releasing. No films were releasing till the OTT platforms came forward and said, we don't mind premiering of films. And so the producers, a lot of producers ran in that direction.
Okay. You talked about the three platforms. I'm also interested in understanding what is the sort of percentage split, if you look at in terms of the Indian income and the foreign income with respect to especially the film industry.
Indian income and foreign income, of course, it depends case to case. There are some films which are made specifically for the niche audience. Those films tend to do well overseas, especially if they star very popular actors like Amir Khan, Shah Rukh Khan, Salman Khan, Akshay Kumar. There are some which are made specifically for the hinterland, for the Indian market. They could do better in home territory. And there are films which do well across the board. But if I were to tell you a ballpark figure, probably 70 to 85% of the revenue, total revenue, comes from Indian market, and 15 to 30% from the overseas market. I'll add over here, ever since the China market opened, there have been films which have done much more business overseas than the entire of India. And two shining examples of these are both are Amir Khan's films, Dangal and Secret Superstar. That's because China contributed almost more than 50%, probably 75% of the overseas pie. So those are, of course, rare cases, but otherwise, generally speaking, 70 to 85% from India, 15 to 30% abroad.
I know you love statistics. So would you have something to share with us in terms of what would be the data which exemplified, the pre-COVID position? Because I'll come to the post-COVID immediately thereafter.
Let's take the example of the biggest hit just before the lockdown, and that was Tanaji, the Unsung Warrior. It netted approximately 265 crore from India theatrical. Overseas was good, but not as strong, obviously, because it dealt with the story of a Maratha warrior. So overseas, it grossed about 50 crore. And from satellite and digital, it made approximately 60 to 70 crore. So 265 from India, about 50 crore foreign territory, and 60 to 70 crore from digital plus satellite.
Okay, interesting. Looking at now the post-COVID stage, since you talked about the various stages in which the entire film is developed, I would like to understand if, let us say today, there was film content which was undergoing development, how did COVID impact that? Secondly, looking at content which is being developed, but it's pre-distribution, how has that been impacted? Content which was in fact distributed but awaiting release, because obviously you time releases according to what else competition exists in the market, and you don't want to unnecessarily compete with another film which is doing well. And lastly, what is the impact on the content that is actually released?
Films which were under development, and they could be two types. Shooting hadn't begun and shooting had begun. If the shooting hadn't begun, people continue to develop them because work from home suited such projects. But for those films which were under production, which means they were already on the sets, obviously all shooting activities came to a standstill, and therefore they are where they were in the pre-COVID days. Those films have been very badly affected. Whether some films were to be shot for just 5 days or 50 days or 2 months or 3 months, shooting is at a complete standstill. And even after the lockdown opens, let me tell you, most of the top stars of the country have decided not to step out of their homes till the sense of security and safety in their minds is higher, because they are sitting pretty on 1,000 crore, 2,000 crore. So they will not take a risk. They have elderly parents, they have young children. So the impact could be felt for a long time. For those projects which were developed and distributed, well, since cinemas are closed, they couldn't be released in the cinemas. But then the OTT platforms came forward and said, we don't mind premiering those films. And therefore, several producers went rushing to the OTT platforms and released the film on or premiered the films on OTT platforms. This actually didn't go down very well with the exhibition sector, which is the multiplexes and the single screen cinemas, because they realized if the films are premiered on OTT platforms, it means cinemas will never be able to screen them. And while on the one hand, they were fighting for cinemas to reopen, they were realizing that film after film was being premiered on OTT platform, giving that much less content for their cinemas when they would reopen. But producers had invested so much, some 60 crore, 80 crore, 100 crore, which is an investment in every film. And they couldn't really wait for too long because the interest factor was killing them. So producers were right in their place. The exhibitors, the cinema walas, were right in feeling bad. But that is how it happened. And yeah, that is it.
In terms of numbers, what would you say, either percentage or an approximate figure, would you say the Indian cinematic industry has been affected by in terms of revenue or in terms of profitability also?
I think the loss in the last 5 months from mid-March to today, mid-August, is in the region of 10,000 crore. The industry impacts a lot of people. A lot of people view movies, but our industry is not very big. So 10,000 crore is not such a huge figure, but for the film industry, of course, it is a huge figure. And yes, cinemas are closed. All shootings are at a standstill, and only work from home as far as films which have not started production or the pre-production work is being done. And now the post-production work, so dubbing, editing, etc., because there you don't require too many people. So with lockdown restrictions being eased, that is happening. But on an average, I would say ballpark
loss already suffered.
Okay. In terms of bright spots in the industry, any resurgences that you have seen for platforms which actually were flailing?
For platforms that were actually?
Which were actually not doing well?
Well, it was the ideal time for platforms like Disney Plus Hotstar, Amazon, Netflix to come in and sort of become the savior for the film industry, because a lot of producers could liquidate their funds which were otherwise locked up because of these platforms, because they came forward and they said, we don't mind premiering the films. And for that, I'll tell you how it works. A film releases first in the cinema in the pre-COVID days, but the satellite rights and the digital rights are oftentimes sold before the theatrical release. Now, all these films which were due for release, ready or almost complete, they had deals in place with the satellite channels and with the digital channels. Now, the digital platforms came forward and said, we don't mind premiering those films. We will pay you extra. So there were negotiations between the producers and the OTT platforms, where if an OTT platform was paying, say, 30 crore for a film, that platform said, okay, I don't mind paying 50, 55, 60 crore. The jump was anywhere between 30% and 85, 90% also in some cases. So on the one hand, producers had to forego the theatrical revenue because cinema release was out of the question, but they got more money from the OTT platform. But when OTT platforms agreed to become the savior, at the same time, the satellite channels called the producers and said, we will reduce the price, the pre-decided price. Now you will have to take a hit because OTT platforms, like OTT platforms, more so the satellite channels, they presuppose that a film is released in the cinemas, and therefore the awareness, the promotion of the film is at its peak, which is the time they come after 2 or 3 months of the theatrical release. Since cinemas are not on and not functioning, since films are not releasing in the cinemas, the satellite channels told the producers, you are premiering the film on OTT platforms, fine. But OTT platforms do not promote films the way you as a producer would promote when coming in cinemas. And therefore, if a satellite channel paid, say, about 50 crore for a film, easily, because of the OTT premiere, that 50 crore would have come down to 35, 36, 38 crore. So, whereas the OTT platform has paid more, the satellite channel has reduced, and overall, in sum total, the producer has had to forego, one, the theatrical revenue completely. Secondly, taken a hit. He has taken a hit as far as satellite channels and in some cases, music, audio rights also. But he has gotten more from OTT platforms. And therefore, every producer, if he was making an X amount of profit, probably has ended up making 80%, 70% of that X amount, because as against some increase from OTT platforms, he has had to take hits from theatrical and satellite channels. To give you an example, I'll talk about Gunjan Saxena, the Kargil girl. Gunjan Saxena, the Kargil girl, Karan Johar and Z Studios spent approximately 35 crore to make the film. And Netflix was not willing to pay them a huge amount. Netflix had the film, but when they said that we'll premiere it, they were not willing to pay a huge amount, which is when Karan Johar said, I'm so confident of my film, which is not very, it's not the usual way. Karan Johar said, I'm very confident about my film, rather
I think, have we lost Komal there for a minute or so? Mrinal, can you confirm?
Yeah, I think I've lost audio as well.
All right.
Yes, I think we've lost him.
Yeah, so I think we'll come back to Komal in a bit. It's time for me to actually get back to my work life. That is Zarina. We'll come to you. I'm not trying to make it sound very dull, but it is also a very key important part of my life, and that is construction arbitration. Now coming to Zarina, in terms of the stress situation that we are seeing in the infrastructure sector, could you sort of elaborate on what you would see as the immediate impact, the medium impact, and the long-term impact?
Hi, good afternoon, everyone, and happy Independence Day. And just wanted to say, yes, since COVID's blocked out real life, we still have these wonderful knowledge sharing platforms. So thank you, Mrinal, for organizing this. And as Sherina said, it's great to reduce our carbon footprint. So that's another positive impact of this COVID situation. Coming back to your question, yes, there are 3 phases that we probably have to analyze the COVID situation in. we'd say, let's say it's the first would be the lockdown impact. I mean, in that phase, there was a dramatic demobilization that had to take place. It was on a mass scale. Almost all work activity had to come to a standstill overnight. There were thousands of workers that had to be demobilized. Most of them, as you know, were migrant workers, and they survive on daily wages, and that had a devastating impact on their lives. The next we have to talk about is material and equipment. Things that we never anticipated had to be stored. We had to make provisions to store them, to secure them. There were contingency plans that we had to make on the spot for all of those processes. Procurement was halted domestically, internationally. This in turn brought up huge issues in terms of the contracts, the delays, deferred payments, terminations, force majeures. And then there were these project timelines. I mean, every project has defined timelines. And as you know, India has the monsoon season. The lockdown occurred just before the monsoon season, and this has had a devastating impact on some of the activities that were supposed to be completed before the monsoon started. So that in itself accentuated some of the delays and have put a lot of spokes into place. And then there are, of course, the financial obligations in the lockdown period. There was equipment that was just idle. There were still vast amounts of money to be paid in terms of salary, labor wages. And in a lot of cases, there were no contingency plans for the lockdown being this long. Bank and financial institutions also, had to be called into play, and we had to figure out what we're going to deal with in terms of the debt refinancing structures. That was the lockdown. Today we are currently in the second phase. We are in the unlock phase, if you please. We have to remobilize, we have to normalize all our site activities, and neither of them are easy tasks given today's conditions. I mean, once the lockdown opened and work was allowed, there were still several restrictions and directives that we had to follow at site. We had to comply with new health norms. We had to comply with social distancing norms. There were a certain amount of restrictions on the laborers we could take in at site to maintain social distancing and other norms. We had to deal with curfew situations, reduced number of work hours, and of course, and then there were travel restrictions, which added to all of those. The entire sector is facing quite a lot of increase in labor costs. Labor costs today have escalated because there is no labor, and there is a shortage of labor, and that itself is causing a cash crunch. And then there are constraints on procuring equipment, especially foreign equipment that has to come from abroad. Movement of goods, that has been hit quite substantially as well. And a lot of times we need experts to come in and do certain things for our projects to perform at certain levels. But with air travel still being at a standstill, there is no question of expats coming into the country at this point. So all of this has caused the cash flow to be a major concern, because each project requires a positive cash flow to run and operate successfully. And since our costs have increased dramatically, these are some things that we are now having to deal with on a regular basis. But the long-term effect, the last part of this question of yours, this is going to be the trickiest, the most complex. I mean, this and every other sector has seen a dramatic increase in its costs. So this will, as Sherina has pointed out, this will increase in the number of disputes. There will be litigations and arbitrations on issues of force majeure, damages, idling, prolongation costs. Every kind of claim that you can imagine will probably be at some point in time disputed. There is some relief on account of reduction of interest rates, but those, again, the true impact of this economic and financial crisis is something that has to be analyzed by an expert like Mrinal. He would have to walk through more than just having site activities come back to normal. He would have to take into equations like financing costs, loss of profits, and so on.
I think just sticking with you, since you made a pertinent point on the sort of disputes that you foresee and envisage. Again, breaking this up into two buckets. One, what are the kind of legal issues that you've seen that have cropped up in this immediate phase? And what about the ones that you will see in the long-term phase? And what is the dealing that the experience that you've had in negotiating with the employers in this particular phase?
Okay. So typically the claims are definitely going to be claims for extension of time and associated costs, claims for idling of equipment that couldn't be used during the lockdown, and they're underutilized today in post-lockdown situations. And of course, there are going to be claims for the increase in the labor costs and for remobilization, demobilization. There are going to be significant claims for all of those. The other claims that are really in the limelight right now are claims for delayed payment. Like I said, cash flows are something that are vital for good site management. And delays in payments have been hampering us across the board. This is not a situation that's likely to change anytime soon. That is something that is going to be a big area of dispute.
In terms of dispute management, we've sort of heard from both Sherina and from Abhileen. But in your view, do you think there's going to be a change in the way disputes are resolved or managed post-COVID-19? I mean, there is news, you keep hearing of NHAI, for example, which boasts of various figures that they're moving towards conciliation and mediation rather than arbitration or just plain old good old litigation. But do you feel that there are changes, or do you think that this is not going to happen?
There are changes. There are changes. Conciliation and mediation have begun to gain more traction. They are being more accepted. They are being more used. But it's not across the board. It's not being implemented by every agency as such. So there are some changes. There is a way to go. There is a long way to go, but it is a step in the right direction. And I think another step in the right direction is setting up of these dispute mechanisms. These to take forward things from let's say from the time the project got over. There is some amount of time before the parties go in for an arbitration, and there are these neutral third-party experts that have been promoted, let's say by ONGC or GAIL. They do step in, they do take note of these, and they have been able to be quite successful on settling some disputes.
Okay. In terms of legislative reforms, I mean, I know we are always been skeptical about legislative reforms in India, but do you think it's about time in the construction sector that we look at something new?
If you're talking of something as dramatic as a new construction law, then perhaps this may not be the right time. We have a lot of other stuff we have to first correct. I mean, take for example some of our labor laws. If we could reform some of our labor laws, get that moving, that would be a great advantage to the sector. And to a large extent, legislative reform it's one aspect, but government policy and government decision on how to interact with this sector, on how it should interact with its contractors, that would be beneficial. If we could have balanced agreements, if we could have standardized agreements, where even the contractor has a little bit, maybe not dramatically, but at least some say in the kind of liabilities that's put on him, or have some rights, instead of being stripped of everything and then have to take it towards the end of the project and only into arbitration. That would help this sector tremendously. Now, implementation of projects also by the government, if it could be standardized, that would be a fantastic way to get rid of some of the problems that we are facing. Dispute resolution mechanisms, we have them in place. Arbitrations, they do work. They're faster than litigations, but there are a few changes that need to be made along the way there too. So in a sense, legislation and some amount of government policy change would at least set us on the right track.
Right. Thanks, Zarina. I'll come back to you a little later. Komal, back to you. I know we got disconnected the last time around. In terms of, you were speaking on the OTT platform, and which do you think will be the new normal? I mean, as you recall, back in the 1980s or possibly, I think early 1980s, there was that entire song of "Video Killed the Radio Star," which is very iconic for the sort of change in technology that we were seeing. And do you see the same thing happening here? That do you think the OTT platform is going to be the new normal? Komal, you're still on mute, sorry.
No, I don't think the OTT platform can replace cinemas for the simple reason that human beings are wired that way. We want to go out. We want to attend parties. We want to see movies with people we may never have met and we would never again meet, but to share the experience. When they laugh, we want to laugh. When they cry, we want to cry. That group exercise is what we are wired for. And there are people who say, I don't think cinemas will work now. It'll never be the same for cinemas because people have gotten used to sitting at home and watching films in the confines of their homes, in the comfort of their homes. Fallacy. There is a major fallacy in this. Firstly, it's not as if people never watched movies at home in the pre-COVID days. Of course, we watched movies on television. We watched movies on OTT platforms. Yes, the difference is that now we have premieres on OTT platforms. But to think that what we have gotten used to in the last 5 months, that is going to become a habit and overtake or demolish our habit of the last probably 50 years, that is not possible. We have been watching films in cinemas for 20 years, 30 years, 40 years, 50 years, depending on how old you are. How can 5 months change a lifelong habit? It can't. So I think this is a stopgap arrangement, and I think OTT platforms also realize that. I was talking to Monica Shergill, the Vice President Content in Netflix, and she said no. I asked her whether they will overtake cinemas or they will coexist, and she said a very nice thing. She said, I don't think we will just coexist. We will co-thrive. Cinemas and OTT platforms will co-thrive just like cinemas and television was co-thriving. Both were co-thriving. So this is a stopgap arrangement, and it will remain that. Films will be made for cinemas, and films will first be released in cinemas, followed by OTT platforms and satellite channels. Of course, even now that what I'm going to say is happening even now, probably it will happen a little more, where films will be made specifically for OTT platforms. There will be 5 or 10% films which are made specifically for OTT platforms. But to think that Karan Johar and Aditya Chopra and Suraj Barjatya and Rakesh Roshan will start making films keeping OTT platforms in mind, no. Hrithik Roshan and Salman Khan will be big screen actors, and we will applaud and clap and cry and laugh with them in the dark of a cinema hall, not in the comforts of our AC rooms, not at all.
I think those are words of hope, for all of us. The fact that we want to see the interior of a mall and of a cinema again, and you're very, very positive about that. That's just great. I would love to wrap up the entire webinar at this particular point, but unfortunately, a couple of more questions and then we'll do that. In terms of what is the innovation that you've seen in the media and entertainment industry over the last couple of months? Obviously, we've been hit by a unique situation. One of the things that had come to my mind was we've seen a resurgence of some of the old television serials. But apart from that, what are the other innovations that you've come across?
Well, we would have seen an innovation because the government authorities almost made that as one of the rules for the standard operating procedures. When they issued the standard operating procedures for allowing film shootings and television and web shootings in the state of Maharashtra, they were very clear, okay, please don't leave Maharashtra. The other states may be more COVID-free, but you'll be here, we'll make it comfortable. One of the rules that almost got passed was, since they wanted as less number of people on the sets and not from different areas. So they said, why can't a star, if it is a family drama, why can't a star come with his entire family and his father and mother play his father and mother in the serial or in the film? Now, they didn't realize that there is something as continuity. You can't have Amitabh Bachchan as the dad of Akshay Kumar for half the film and Akshay Kumar's uncle playing his dad in the other half. So nothing much can change for the film and television industry because these are larger than life creations, recreations, So I don't think much has changed except that star wives will have to worry less. Otherwise, we used to have affairs on the sets. Now, probably, social distancing may affairs
Okay, I mean, there's being candid and there's this, so thank you for that. Thanks so much, Zarina. Coming back to you, in terms of opportunities, in terms of revival, just a couple of points. One, we've recently seen a report from the Asian Infrastructure Investment Bank, which says that the outlook remains robust in Asia, especially in the EPC sector. One, your views on that. And secondly, a bit more controversial, and I would understand if you would not want to address this point, is the fact that today we have seen a sort of economic face-off with China. And because of that, there have been certain government policy measures. This has resulted in an opportunity for Indian EPC contractors. What is your take on this?
Okay, I'm going to answer your second question first. In terms of the face-off with China, yes, in the short term, Indian companies, they're going to have the ability to compete on a better footing. They will be able to bid and not have this sword hanging over their head that the Chinese are going to outbid them no matter what they do, no matter how much better technology they come up with. But I think this is a short-term band-aid. If this sector in India is to grow, is to get better, we do need those legislative reforms. I talked about. We do need standardizations. We do need implementation of policy that will give us better strength, not just to compete in India, but maybe then grow, become globally a global challenger. We ought to be. And if we want this kind of success, we have to look internally. We have to find better management strategies. We have to overall get our efficiency up. We do that, even in terms of the second question that you asked me, whether the outlook looks good. It does look good, but we have to do everything in order for that to look good for us, not just for somebody else. Yeah, Asia needs a lot of infrastructure. Yes, there is a lot of potential for development. We just have to be able to take advantage of that for ourselves.
Great. Thank you so much, Zarina. I think hopefully in the next year or so, you would be assisting Komal build a mall and a cinema theater, and hopefully we will be customers therein. So
I actually have something there to tell Mr. Komal. Mr. Komal, I actually own a cinema.
Oh, which one?
Victory Theatre in Pune.
Oh my God.
And I'm very, very heartened to hear your comments that yes, we will open, yes, you will thrive, and I am waiting for that. I am waiting to see my theatre house full.
Yes, I'm telling you, the collections we see, once of course people start returning to the cinemas in large numbers, the collections we see will be of the kind never seen before, because people are dying to go to the cinemas. So just hold on.
Oh, I'm holding on, believe me, I am.
Victory will be yours.
That is the hope.
Thank you so much. Extremely entertaining and informative. I think we have time for a few questions. Namrata, I think you've jotted down a couple of them for possibly Abhileen and for Sherina. You could probably start with that.
Sure. So, Abhileen, there's a question on force major. Yeah. I thought you could comment on that, and on that is something that has come up quite frequently, especially at the beginning of the pandemic. Force major was discussed at length. What do you think are the other provisions in contracts, such as change to law claims?
Oh, I was in fact just going to reply to that question. I was just typing the answer over there. So see, change of law is something that would be defined within the contract also as to what constitutes that change of law. If this is something that may be covered within the agreement, you can definitely argue that this may be a change of law provision. Having said that, there is a lot of differences when it comes to the central government imposing lockdowns and some of the state governments continuing those lockdowns for periods thereafter. Some state governments continued it, some state governments did not continue it. So that person will, whosoever is asking the question, will have to see which state, and does the state cover that notification, or did the state continue with the lockdown? Depending on those factors, and most importantly, the language employed in the contract, this could be taken as something apart from a force majeure event as well.
Thanks, Abhileen. Alok, I think you're on mute.
There was one question that we had for Sherina, actually, which is posed by somebody who's been viewing this on the live on Facebook. And that was, in terms of the international perspective, what are the sectors that you've seen which have gotten affected? We've heard two industry leaders in the form of Zarina and Komal, but what has been your experience globally in terms of the sectors which have been affected?
Actually, I'm really glad someone asked that question, because I did say at the beginning that I will touch upon the sectors, and then because of time, I didn't. So thank you. I would say, I mean, I already touched upon what the HKIAC saw right at the beginning with some statistics, but I would say really energy, construction, retail, travel and tourism, and shipping, international trade. Let me just quickly touch upon energy. The energy market has been in turmoil before COVID-19 due to price wars between its key players. However, COVID-19 has had a huge impact on the sector, largely due to the unprecedented shifts in the demand patterns. An interesting, actually simple example is the change in how increased working from home has changed the electricity demand. And that's just a simple example. Therefore, particularly in areas in which we are served by renewable energy sources subject to larger supply variation cycles, this means that existing contracts and supply arrangements are likely to be revisited. Many power generators are facing their counterparties across negotiating tables. Such large-scale changes will obviously eventually lead to a new wave of energy disputes. I'm seeing some of them already surfacing. Many claims, particularly those in relation to projects at the exploration phase, are currently put on hold as businesses are limiting their spending due to the economic situation for commodity, due to the economic situation, which we already touched upon, cash flow, etc. Talking about construction, what can I add when we've got Zarina, who's so beautifully and lucidly covered the field? But for my 2 bits of information, I think as governments across Europe begin to ease lockdown restrictions, the impact of COVID on the construction industry is starting to reveal itself, surely but slowly, slowly but surely. Commercial construction plummeted overnight, where with social distancing, self-isolation measures coming into force, delivery times lengthening due to transport issues and supply storages. Other factors included sickness and repatriation of migrant workers, all of which had a major effect on productivity. Construction was also one of only a handful of sectors that were not subject to blanket shutdowns by governments, which created a lot of problems for site operators and contractors who were expected to continue working despite labor and materials. Going on quickly onto retail, lower revenues due to decreased customer footfall is expected to have an impact on performance of various contractual obligations, including under lease arrangements in the retail sector. Travel and tourism, I've seen that's been hugely hit. Catering, on the aviation side, hotels, there's a multitude of claims that are expected on account of consumer claims relating to travel, aircraft order withdrawals, etc. And I'm seeing a lot of those kind of disputes personally myself from clients coming to us. And then lastly, shipping and maritime. Though ports have largely remained open to cargo vessels, The COVID-19 pandemic has obviously impacted the shipping industry due to shortages of crew, closure of shipyards, restrictive measures being implemented by certain ports to ensure safety. And I think we'll see various disputes arising from breach of clauses in ship sale agreements, shipbuilding agreements, charter parties, and other contractual agreements. So I hope that's kind of a quick bird's eye view across the sectors.
But thank you so much. I mean, that's an interesting way you put it, because it covers all of the sectors and also highlights what are the key points in those sectors which are likely to be affected going forward as well. So thank you so much, Sherina. I think we've had a lot of questions coming in, but unfortunately, we don't have the time to deal with all of them. There are a couple of juicy questions for Komal, but I'm not going to really ask those. In fact, I have somebody from my CorpCom team who's very interested in asking you that question. I'll put you in touch with them later. But there is something that we would like you to end with, so please go ahead.
Zarina, this one is for you. Since you're the legal head of Shapurji Palonji, and let me add here, for those who don't know, Shapurji Palonji had produced the film Mughal-e-Azam, the blockbuster, the cult classic, which just on 5th August 2020 completed 60 years. It was the 60th anniversary of the film. So congratulations, and long live the film industry, long live disputes, long live arbitration, and long live construction.
Thank you so much. Thank you so much. You guys have been great. Naresh, last few parting thoughts.
It's just been fabulous, hearing all the panelists. Extremely engaging. I must say, the most. Yes, arbitration is something I do so very often. So therefore, that's an arena I'm quite familiar with. But Sherina, you bring, as always, tremendous amount of value when you're on any such panel. From an international perspective, I don't think and this is the truth. There are very few players really in the international market who can match Sherina in all that she brings to the table, including being so lucid in her thoughts. Komal, yes, I must say that you bring a lot of optimism on the house. We all have been quite pessimistic. Lawyers tend to become that. When you hear depressing stories all the time, you tend to get more and more depressed yourself. So never meet a lawyer, other than when you're going to him for some issue. But you brought that optimism. Thank you so much for that. Zarina, again, I must say, from a construction industry perspective, I think you've laid out for us exactly what to expect. Well, I must say I'm quite excited. I know that there are going to be issues. We are seeing a lot of issues. In fact, as we speak, currently we are doing a matter, and again, that's a matter which we are doing online. So the issue that we spoke about, matters being taken up online and virtual hearings. To my mind, it's going to become the norm in the near future, especially when you have a cross-border litigation and a cross-border dispute. You would rather not travel for the small stuff that people used to do at a given point in time. People have stopped traveling by and large for procedural issues. You don't see internationally people traveling at all. But I think there will be far more changes which will come in. I truly look forward to it. There's no point in landing up in Paris and then being cooped up in a room, arbitrating. I would rather go to Paris to see the place and to enjoy the vibe, and not otherwise. Well, I think Saugata has dropped off, but I must say, from an economic perspective, being a lawyer, and that too, someone who deals with economic issues all the time, and that's something that I've done all my life. I have a lot of interest in understanding the economic impact, because that is exactly what us lawyers are supposed to do. We have to understand the client and the client's business, rather than just going ahead and giving a spiel on what the law really says. Because it's more often than not, what I have realized is that you may want to win the matter because you believe that the law is on your side, but the client has quite a different take on the whole subject. So unless you understand the client and the business, and therefore the economics, I don't believe that you will ever be able to, as a lawyer, ever be able to bring a full justice to the matter. Namrata, thank you so much for being the moderator that you are. It's absolutely fabulous the way you've taken it through. And to my two partners, well, a lot of work to be done in the coming few days. So therefore, gear up. I'm not going to say anything about you two guys. You are the two pillars truly of the arbitration practice. Both of you know it. But thank you all so much. And Mrinal, I think each one of the panelists have, said it. You have done a fabulous, fabulous job in organizing the whole thing. I mean, trust me, if left to me, I would have, bungled up the whole thing. So thank God it's in your hand and not in mine. So thank you so much once again. Thank you all for being a part of the panel. It's been fabulous. Thank you.
Thank you.
Thank you.